In early 2022, two Philippine REITs, AREIT and RCR, stood out, offering steady dividends and prime office portfolios from respected sponsors. With bond yields low and deposit rates anchored, investors pushed AREIT above 52 pesos and RCR near 8.80 pesos per share, seeking dependable income. But the real driver wasn't just operational performance, it was the price paid for income, influenced by what yields investors could find elsewhere. Throughout 2021 and into early 2022, the Bangko Sentral ng Pilipinas kept policy rates at 2%, making REIT yields attractive compared to alternatives. RCR's IPO offered a yield near 6%, and AREIT's dividends exceeded projections, reinforcing their perceived safety and reliability. Then, in May 2022, the BSP began raising rates, signaling the end of cheap money and changing the risk-return equation for all yield assets. As government bonds and deposits began yielding more, REITs could no longer command a premium. Investors demanded higher yields, pushing prices down. AREIT and RCR continued to deliver solid operational results. Revenues and net income rose, portfolios expanded, and occupancy stayed high. Share prices fell not because of business failure, but because rising rates made other income options more attractive, raising the required yield and lowering prices. AREIT weathered repricing better thanks to its track record and reputation, while RCR's fall was sharper due to fresher IPO enthusiasm and compressed yields. In both cases, REIT prices reflected changing monetary policy, not collapsing businesses. Duration risk and yield repricing drove the adjustment. The fall from 2022 peaks signals that strong fundamentals can moderate declines, but not override the impact of rising rates on valuations. Ultimately, REITs mirror both their properties and the shifting tides of monetary policy, a lesson for investors in any market cycle.